Bloomberg Audio Studios.
Podcasts, radio, news.
Well, the RBNZ governor says a broad decline in CPI inflation is not happening across all sectors of the economy. The RBNZ, as I said yesterday, signalling that policy will stay tight for longer after keeping rates unchanged for a seventh straight meeting. Joining us now from Wellington is the RBNZ governor, Adrian Orr. Governor Orr, it's always a pleasure to have you with us. I know you've been doing a lot of talking over the past 24 hours or so, and I'm going to ask you for a bit more insight into that decision. And again, much like the last time we spoke, the possibility of further tightening was again flagged, particularly when it comes to, some of these elements that you've said domestically have been perhaps more resistant to monetary policy. I guess the question would be, would another rate hike be meaningful when it comes to getting those aspects of inflation lower?
Another rate hike would only be meaningful if we thought inflation expectations were getting away on us again, starting to rise because of the persistence of actual inflation. We know that forward-looking inflation is heavily influenced by the current level of inflation. So that's our main concern. Persistence raises the risks that expectations don't do the job that's needed. We know and we are confident that we will get inflation down to the 1% to 3% band. We'd just like to make sure we get there soon without risking that another blowout in expectations.
You talked about the risk appetite as a committee and that the asymmetry is the ability to withstand the risk of higher inflation, right? Do you see that increased risk with some of these elements that are leading through to more difficult to shake inflation expectations?
Yeah, we're actually quite pleased. We spent a lot of time in the document we produced yesterday really getting down to the nuts and bolts or the rats and mice of what is left in that consumer price index, the bits that are persistent. We've seen a lot of success in getting the cost of housing construction down, a lot of other services prices down, goods prices, the easier to move. The bits that are left are insurance. They've all got their own idiosyncratic story. Insurance premiums because of what's been happening globally around the extreme climate. We've got central and local government rates rises. They're always lagged. And there's some indexation left in the economy, which is keying off historical inflation. So, we're not surprised that getting from 4 to 3 to 2 is much harder than getting from 7.5 to 4. We are showing patience, but, we have to remain highly aware to any further upward price spikes and what that may mean for price-setting behaviour. We've been trying to emphasise... Sorry.
No, continue.
We've just been trying to emphasise that if price setters pull their heads in and accept that we're going to be in a low inflation environment, wage expectations and actual wages have come down considerably. So, we're just working through this last part of the puzzle. No difference to effectively what you're seeing globally. Tradable goods prices fell very quickly, and then this homegrown domestic stuff is always more sticky.
And I get that sort of non-tradables element is going to be crucial here as well. But you said that you have limited tolerance for inflationary surprises to the upside. Is that patience kind of almost running out? Do you look at that second quarter CPI print as the one that maybe makes or breaks that decision to go again or not?
No, we're not hinged off any one statistic, and no, patience hasn't run out. What we are showing is that we've got a lot of patience. Our projection is to keep the official cash rate at 5.5% until early next year. That we believe that will have inflation back down within the band, and at that point we can start thinking about normalising interest rates. That's all in our projection. The sticky prices that I've talked about, and particularly over the next couple of quarters, have been well signalled, and they are in our inflation projections. So it'd have to be something over and above that again to really, to surprise us. And we think the risks are balanced over the period ahead that matters for us this time next year. Without doubt, the economy is performing below its potential. An output gap is opening up. Disinflation is occurring. So we feel pretty comfortable But when you're starting from a higher inflation position, when you've got low productivity, the central bank has to remain alert.
Do you think, though, that given you are seeing those cooling trends coming in and you're really getting that weaker or softer economic data now, even though you have that component where non-tradable inflation data is still elevated, do you think that there's that need to get inflation back to that target band first before cutting, given there is that lag transmission effect as well?
No, that's you're exactly correct, and in fact our projections have us easing interest rates before inflation is back at that midpoint, because you are right. We have economic growth picking up here in New Zealand in our projections from this quarter onward, but the level of economic activity is still below the potential. So, we can start to ease before CPI inflation exactly hits the midpoint of that target, and that's what our projection has. We're at 2.9. I think our projections have us around 2.9% at the fourth quarter this year. That's a toss of the coin whether it's in or out of the 1 to 3 band, and it's not soon after that we signal lower interest rates beyond that. So what did we do to surprise the market? That it's not happening next week, and we've been saying that for some time.
You definitely do seem to have caught a few investors on the hop over the past few months. But Governor, you said that you expect growth to pick up. Where do you think that growth is coming from, and why do you think the New Zealand economy is able to cope with such a sustained period of elevated rates?
The growth is coming through from government spending, government investment. We are looking at private investment starting to come back. Building consents, etc., have levelled out. And importantly, we've had a 2% per annum growth in our working age population. So migration has been considerable. The really tough stuff is that aggregate demand has been rising, per capita spend has been falling. And the difference is the population's been growing. And so that has been putting the upward pressure on rents, on demand for dwellings, and that's kicking construction activity back in. The pipeline of infrastructure investment that's in front of New Zealand is long. And of course, the world is open up again. So our tourism is finding its feet. And likewise, with global growth expected to pick up, our trade is also growing. So there's lots and lots of economic growth, but there is that rebalancing from consumption to production.
Governor,
when it comes to some of the elements that you just talked about, dwellings, the supply side of dwellings, rental costs rising, if there is a sharper than expected decline in immigration, would that meaningfully change your outlook when it comes to growth? And does that more impact, when it comes to the labour market side or when it comes to the inflationary demand side, do you think?
Yes, so, the real challenge is you can't just change one thing and leave everything else unchanged. The type of scenario there of if migration slowed much quicker, then aggregate demand slows quicker, and then we wouldn't be as exorcised about the level of interest rates. When the facts change, your opinion has to change on the way through. But likewise, we continue to have a dwelling shortage in New Zealand. It's not unique. It's in these countries that have experienced rapidly high immigration, and we need to keep building dwellings. Public, state housing, public dwellings, private housing, so on and so forth. Housing construction costs have come right off. We've been successful at achieving that, but rental costs are high because there's still more demand than there is supply for people who don't own their own home but want to rent.
Governor Orr, very quickly before we let you go, you talked about fiscal spending as being one of the upside pressures. Ahead of the budget, do you expect that tension to continue to play out? Because we've seen across other economies where the fiscal side has, inadvertently or not, really undermined the effect of monetary policy. Yes,
it's a global and forever challenge. The synchronised monetary and fiscal policy is extremely difficult. We've been fortunate here in New Zealand over the last couple of years. The government spending as a proportion of potential output has been declining, and that means it has been disinflationary. It has been helping the Reserve Bank. It has been disinflating on the way through. That is still the expectation from the official projections to date. Of course, we'll wait to see what the budget has. But, in the absence of that fiscal discipline, then yes, monetary policy would have more work to do. And so, we're going to have to see what, if any, additional government spending restraint will be, and the impact of tax changes
Governor,
on private
really great
spending.
to have you with us. Governor Adrian Orr there.